In the first half of 2025, Canada reduced its exports to the United States by $7.7 billion AD, marking the sharpest year-over-year decline since the pandemic. The U.S. share of Canadian exports fell from 78% to 68%, a 10-point drop in under a year. Shipments of oil, critical minerals, auto components, and processed metals all saw significant reductions. U.S. importers dependent on Canadian supply lines are now facing sourcing gaps, contract delays, and sudden price increases with minimal notice or room for negotiation. This isn't a side effect of broader global conditions, it's a direct response to new U.S. tariffs implemented in late 2024 and early 2025. From Ottawa's perspective, the U.S. is now considered a trade risk, and Canadian producers are being redirected to seek alternative markets. The $7.7 billion CAD isn't lost, it's being redirected. The reductions aren't random, they are concentrated in key sectors. In energy, crude oil and refined petroleum exports to the U.S. declined by more than $3 billion compared to early 2024. LNG shipments also dropped, with volumes shifting to East Asian and European buyers. The auto sector took a substantial hit. Canadian exports of engines, transmissions, and EV battery materials into the U.S. Midwest supply chain are down more than 18% year-over-year. Several Tier 1 Canadian suppliers exited U.S. contracts mid-cycle, instead opening negotiations with German and South Korean OEMs. Other affected exports include aluminum, processed wood, and construction-grade steel, all critical to U.S. manufacturing and housing. The turning point came in late 2024, when the U.S. expanded its tariff framework under an updated Strategic Materials Protection Act. Originally targeting China, the scope widened to include non-U.S. steel, aluminum, and specific battery components, including those from Canada. By Q1 2025, dozens of Canadian exporters were hit with compliance audits, tariff penalties, and customs delays, despite existing agreements under USMCA. Ottawa saw this as a breach of trust, a sign that U.S. trade policy was shifting unilaterally. In response, Canada launched a rapid diversification campaign. Trade officials began fast-tracking deals with Europe and Asia, revitalizing previously stalled agreements with Germany, South Korea, and India. There were no flashy press conferences. The transition happened through port reassignments, rewritten shipping contracts, and new incentives for reducing U.S. trade dependence. Canada didn't retaliate with tariffs, it simply moved its exports elsewhere. In early 2025, the Trade Ministry issued a revised export directive prioritizing outbound trade diversification. Policy documents emphasized the need to reduce over-reliance on U.S. markets and to build long-term relationships with less politically volatile buyers. Behind this messaging was a coordinated national strategy. Canadian producers in energy, auto, and resource sectors are now supported by financial tools, trade guarantees, and tax preferences to pivot toward global markets beyond North America. This is not a short-term workaround. Federal agencies have signed logistics agreements with South Korea, India, and the Netherlands. Infrastructure investments are now flowing into eastward-facing ports, inland freight hubs, and customs modernization tailored for Asia-Pacific trade. The U.S. export decline was no accident. It's part of a strategic effort to reposition Canada as a global supplier with reduced trade concentration risk. Canada's trade policy has shifted, and so has how exporters allocate supply. Washington is no longer the default destination. Canada is restructuring its physical trade infrastructure to reflect new priorities. Atlantic and Pacific ports are seeing surges in outbound traffic to Europe and East Asia. Containerized shipments from Vancouver to Busan and Yokohama have increased significantly. Halifax is expanding rail-linked exports to Germany and the Netherlands, including steel, machinery, and energy components. Rail infrastructure is adapting too. Freight volume from central Canada to U.S. border crossings is dropping, while eastbound and westbound container flows are rising. Newly signed logistics agreements in Q1 2025 include port access in Singapore, Rotterdam, and Chennai, all structured to streamline Canadian exports through customs alignment and bilateral inspection protocols. This isn't just a strategic shift, it's an operational overhaul. Cargo routes are changing. Shipping contracts are being revised. Container volumes are already rerouted. U.S. importers are watching long-standing supply corridors vanish in real time. And it's not driven by politics. It's being executed quietly by trade ministries, logistics planners, and exporters optimizing for global reliability. Canadian exporters aren't just exploring new markets, they're securing binding contracts. Ontario-based auto parts firms have signed multi-year agreements with German and South Korean automakers to replace lost U.S. volume. Alberta energy producers are locking in LNG contracts with East Asian buyers via Pacific ports. These aren't speculative deals. They come with guaranteed delivery volumes, fixed container allocations, and policy-backed trade financing. Export Development Canada has expanded credit lines to companies shifting to Europe and Asia, further eroding the attractiveness of the U.S. market. For American buyers, this means lost volume isn't just paused. It's being permanently reallocated. This isn't a temporary shift that will reverse with future policy changes. Logistics lanes, legal frameworks, and port schedules are already filling with new partners, pushing U.S. buyers further down the priority list. Companies that once assumed Canadian supply was a given are now learning that those shipments weren't just delayed, they were redirected for good. In 2025, the long-standing assumption that Canadian inputs were a reliable default broke down. U.S. firms in construction, automotive, and energy had built supply chains heavily reliant on Canadian raw materials and components, often without backup options. Aluminum, timber, wiring assemblies, refined fuel, and EV parts were sourced based on proximity, not redundancy. That model no longer holds. When Canada reduced its U.S.-bound export volume, most American buyers had no immediate alternatives. Inventories ran low, deliveries stalled, and profit margins thinned. Some manufacturers tried pivoting to domestic or Mexican suppliers, but capacity wasn't there. Others scrambled to issue last-minute tenders in Asia, often facing higher costs and longer lead times. This wasn't a typical supply chain disruption. There was no natural disaster, no geopolitical conflict, just a trade partner rebalancing its risk. And the U.S. was unprepared to respond. Buyers are now experiencing the consequences of relying on geographic convenience without aligning policy, and they're paying for it. Not just with delays, but with a long-term restructuring of access. The U.S. system isn't designed for rapid, large-scale substitution. Many of the goods Canada supplied, semi-finished metals, energy inputs, specialty components, don't have like-for-like replacements elsewhere in North America. Domestic production is limited, often more expensive and slower to mobilize. The infrastructure to replace the lost volume doesn't exist, not at the necessary speed or scale. Warehousing wasn't designed to store 6 months of stock. Rail and trucking corridors were built for short-haul Canadian inputs, not long-haul overseas alternatives. U.S. firms that relied on just-in-time logistics are now dealing with disruptions in both supply and planning. Even where options exist, in Chile, Indonesia, or India, shipping timeframes and customs hurdles erase any pricing advantages. Onboarding new vendors also takes time that U.S. buyers don't have. This realignment has exposed a structural flaw, deep supply dependence without a strategic plan. The supply chain wasn't guaranteed, yet the system operated as if it was. Now, buyers are being forced to adapt under pressure, not on their own terms. Diplomatic alignment doesn't guarantee trade reliability. That became clear in 2025. After the U.S. tariff expansions in late 2024, Canadian officials sought exemptions through formal channels. Washington's response was slow, disjointed, and noncommittal. Behind closed doors, Ottawa's stance shifted. Internal government documents, reviewed by analysts, confirmed that the move to reduce U.S. exposure wasn't economic in origin. It was political. Trade reliability now includes the predictability of a partner's policymaking. U.S. trade policy has become difficult to forecast, and that carries economic risk. Canada didn't respond with protest, it responded with withdrawal. Bilateral meetings in Q1 2025 failed to secure terms on steel, energy, or key components. Canada proceeded to implement trade alternatives without delay. Publicly, the tone remained diplomatic. Privately, the decision was final. Supply chains often shift because of price. This time, they shifted because of trust. And once institutional trust is broken, reversing trade momentum becomes far harder than renegotiating cost. Energy, once the most stable line in Canada-U.S. trade, has now shifted. By Q2 2025, U.S. imports of Canadian crude oil, LNG, and refined petroleum had dropped by over $3 billion Canadian dollars. Much of that volume has already been reallocated to Asia and Europe through new contract frameworks. Canada's West Coast terminals are now shipping LNG to South Korea and Japan under long-term deals. Refined petroleum is moving to Rotterdam and Antwerp. Smaller EU nations have expanded fuel contracts with Canadian suppliers to reduce dependence on Russian sources. None of this was reactionary. It was part of calculated pricing and policy realignment. As U.S. tariffs and regulatory uncertainty began to obstruct cross-border flows, Canadian producers accelerated their global repositioning. For decades, U.S. buyers assumed energy security through geographic proximity. But today, proximity no longer guarantees priority. The result, a redefined energy corridor, with the U.S. shifting from preferred buyer to backup option. There is still an opportunity to recover lost trade, but no time to waste. For Canadian exports to flow back into the U.S. at previous levels, Washington would need to roll back recent tariff policies, simplify compliance rules, and re-establish stable terms for critical goods. None of that so far is in motion. Meanwhile, Canadian exporters are finalizing global contracts, complete with fixed delivery volumes, pricing guarantees, and government-backed financing. Once those agreements are locked in, reverting to U.S. buyers would mean incurring penalties and resetting logistics, an expensive and complex reversal. Even if U.S. policy changes next year, lost volume won't simply return. Canada has already retooled its trade infrastructure. Its supply routes, customs channels, and shipping schedules are now optimized for Europe and Asia. Trade doesn't just follow price, it follows structure. And that structure has now changed. The window to retain priority access is closing. Without timely U.S. action, the issue won't be lost volume. It will be fighting for leftover capacity. Canada's export pivot isn't symbolic. It's measurable, contractually bound, and already in motion. That $7.7 billion CD in lost U.S.-bound exports isn't a projection. It's an active redirection. Ottawa's policy shift is real. The infrastructure changes are underway. Supplier behavior is being locked into binding agreements and financial instruments across key sectors. This isn't a temporary pause. It's a reordering of priorities. And the U.S. isn't leading the transition. For decades, North American economic integration meant U.S. buyers set the terms. That assumption no longer holds. Canada is forging new trade dependencies, rerouting critical exports, and designing its future trade around stability, not just geography. The question now is straightforward. Will the U.S. rebuild trust and restore access, or remain on the sidelines of its closest supplier's export strategy? Let us know in the comments below.